this week's market update. Companies are in focus as earnings season unfolds, political uncertainty deepens on both sides of the Atlantic, and currencies dominate financial markets. Well, sometimes it's easy to forget that markets are driven by the bottom-up fundamentals of corporate earnings and dividends. These matter quite as much as the top-down big-picture factors like interest rates and political developments. 4 times a year, however, earnings season arrives to remind us that investors buy shares in individual companies, not in the market as a whole. And right now, we're in the thick of a very interesting batch of results. The good news is that results so far have been pretty good on average. Around 3/4 of the S&P 500 companies to have announced results so far have beaten earnings and sales forecasts, according to FactSet, the data provider. That's helped equities get off to a strong start this week, with both the S&P and Nasdaq close to the record highs they hit last week. The Dow Jones hit a new all-time high yesterday, and closer to home, the FTSE 100 is back above 7,400, within striking distance of its recent peak. Top of the agenda last week has been the technology sector, with a mixed bag of results from the likes of Google, Facebook and Amazon. Amazon in particular sent a tremor through both the tech sector and the wider market when it stuck to the script that has guided its development over the past 20 years. That's investment and growth at the expense of short-term profits. Amazon, under founder Jeff Bezos, who briefly became the world's richest person last week, has long argued that shareholders are best served in the long run by cementing the company's dominant position in online retail, by building the best computer systems and on-the-ground logistics, even if that means that profits and dividends have to take a back seat. Now, Amazon is in the middle of a particularly heavy investment phase at the moment, which means that profits in the quarter just reported were barely a quarter of analysts' expectations. In the third quarter just started, the company warned it will probably make a loss. Capital expenditure grew twice as fast as revenue in the second quarter, and headcount is rising fast. But Amazon is an unusual tech stock because it's also building a significant presence in the old world of bricks and mortar retailing. The acquisition of Whole Foods, for example, will add 100 stores overnight. So Amazon shares retreated a bit on its latest figures, and the big question is whether this is just a temporary blip or a sign that investors are reassessing the company's long-term value. A pause for breath would be understandable, as its shares have risen by around a third since the start of the year, and they're 3 times as high as they were 3 years ago. The company's now worth more than $500 billion. Now, this week's focus will be on Apple's figures later today. Like Amazon, Apple has enjoyed a fantastic run over the past year, up by around 50%. But again, there are question marks over the long-term outlook as the company looks for the next big thing 10 years after the launch of the first iPhone. Technology, of course, has been a major driver of the overall market, particularly in the US, over the past 18 months. And investors are rightly concerned about a narrowing in market leadership. That's often been the prelude to a market cycle peak in the past. Certainly, in the final stages of the dot-com bubble in 1999-2000, all eyes were on technology in a way that is worryingly familiar today. Other sectors in focus this week have included oil, where a string of big energy company results have benefited from the doubling of the oil price from its cyclical low in January 2016. In combination with cost-cutting programs at most companies, it's now clear that the industry can make money and, crucially, pay its dividends at today's $50 a barrel oil price. That's a big relief to investors for whom the sector is a big source of dividend income. Shell's an interesting example. It's managed to reduce its break-even point, where cash flows cover investment and dividends, by 60% over the past 4 years, from $120 a barrel to just $47 a barrel this year. Now, that's been critical because that is pretty much what has happened to the oil price over the same period. With US shale oil filling the gap created by OPEC production cuts, there's little prospect of the oil price rising much from here, so companies know that their success in future will largely come down to self-help. One sector in the headlines for the wrong reasons last week was tobacco, which saw share prices tumble after the US announced that it was considering a cap on the amount of nicotine in cigarettes at a level that the medical experts deem non-addictive. If such a cap were imposed, it would represent a serious blow to the business model of one of the stock market's most defensive sectors. At one point, shares of Altria, which makes Marlboro cigarettes, fell by 19%, although they rallied to be 10% lower on the day. British American Tobacco, whose brands include Camel, fell by 14% before recovering to be 7% lower. By contrast, shares in a company called 22nd Century Group, it's a biotech company that's developing low nicotine products, the shares rose by 14.5%. There was one further calamitous share price movement last week as AstraZeneca, the pharmaceuticals giant, shed 16% of its value on the back of a failed lung cancer drug. Drugs groups are extremely vulnerable to disappointing trial data, but even by the standards of the sector, this was a spectacular fall from grace for a FTSE 100 company. Although companies are the main focus at the moment, investors are keeping their usual close eye on central banks. Last week, it was the Federal Reserve in the spotlight after its latest policy-setting meeting set off alarm bells in some quarters, with a subtle shift in its commentary that seemed to heighten doubts about whether we'll see even one more rate hike this year. Insipid US GDP data has done little to encourage the prospect of higher rates, and a string of tepid employment and inflation data also suggests caution from the Fed. As a consequence, the dollar remains in investors' crosshairs. The euro ended the week 0.7% higher against the dollar at more than $1.17, and the yen and pound have also gained against the US currency. Weakness in the dollar is also a consequence of growing concerns about what is going on in the Trump White House. Indeed, last week has been described as the worst for a US president in recent memory. We've seen the dismissal of Chief of Staff Reince Priebus, the sacking of new Director of Communications Anthony Scaramucci. That was after a foul-mouthed tirade to the New Yorker magazine and came within 10 days of his appointment. We've had the failure to repeal former President Obama's healthcare bill and growing evidence that the president is losing the support of the Republican Party a year ahead of midterm elections. Growing numbers of US politicians are starting to see their leader as a liability rather than an electoral asset. Now, on this side of the Atlantic, the political climate is no less febrile, with Theresa May's 3-week walking holiday providing her cabinet rivals with the opportunity to present alternative Brexits to her hardline approach to leaving the European Union. In particular, Chancellor Philip Hammond has outlined a vision of a softer Brexit, one with an extended transition period that effectively turns the existing 2-year timetable into a 5-year negotiation, with the only real deadline being the next general election in 2022. Mr Hammond, along with other soft Brexit colleagues like Amber Rudd, wants to see a soft Brexit which minimises disruption to business and puts the economy ahead of immigration, and which leaves Britain more closely entwined with Europe than their Eurosceptic colleagues in the party would choose. But this week, the hard Brexiteers hit back. Downing Street insisted that it remains committed to ending the free movement of EU citizens in the UK from March 2019. And Liam Fox, the International Trade Secretary, says that only that would keep faith with the decision a year ago to leave the EU. Meanwhile, civil servants are increasingly restive. Many are complaining that an indecisive government has wasted the first year since the referendum. So later this week, we'll get an insight into how the Bank of England views all that ongoing political uncertainty as it sets interest rates. Most likely it will leave them at a 300-year low of 0.25%. Following last week's tepid second quarter growth of just 0.3% quarter on quarter, 1.7% year on year, there's little incentive for the bank to risk the economic recovery with a premature rate hike. And it would be surprising if the 5-3 vote in favour of no change at the last meeting did not become 6-2 or even 7-1 this time around. The bank decision will be confirmed on Thursday.